Property investors are dropping Portugal for an island nation most people can't even find on a map. The numbers are shocking and the reasons might surprise you. Here's why Mauritius is quietly becoming the smartest real estate play in 2026. Portugal used to be the golden child of European property investment, but something changed. While everyone was focused on Lisbon's rising prices, savvy investors discovered an Indian Ocean paradise, where your money stretches 3 times further. The catch? Most people think Mauritius is just another expensive tropical vacation spot. That assumption costs buyers hundreds of thousands of dollars, and choosing the wrong market at the wrong time can lock your money into a property that underperforms for years. One of these markets looks like the smarter deal today, but quietly becomes the worst investment once you factor in timing. Picture owning beachfront property where your morning coffee comes with ocean views and your biggest decision is which pristine beach to visit. Now imagine paying less for that privilege than a cramped apartment in Porto. This isn't fantasy real estate marketing. The numbers are real and they're creating millionaires. But there's a twist coming that changes everything about how these two markets actually compare. For deeper insights into both markets, including detailed cost breakdowns and visa requirements, join the Horizon Society School Group where members share real experiences and current market intelligence. Portugal's property market hit turbulence in 2024. The government axed the Golden Visa program for real estate investors. Overnight, the primary driver pushing property values skyward vanished. Prices that seemed unstoppable suddenly faced reality. Foreign buyers who built wealth strategies around Portuguese real estate found themselves scrambling for alternatives. The immediate impact was brutal. Lisbon property prices dropped 15% in 6 months. Porto followed close behind. Developers who counted on Golden Visa buyers watched projects stall. The market that once promised guaranteed returns became uncertain territory. Meanwhile, Mauritius was quietly building something different. While Portugal dealt with political backlash against foreign investment, Mauritius rolled out red carpets. The government created investor-friendly policies designed to attract exactly the buyers Portugal was pushing away. Here's where it gets interesting though. The real reason smart money moved to Mauritius wasn't just about Portugal's problems. Mauritius offers something Portugal never could: zero capital gains tax on property sales. Think about that for a second. Buy a property, watch it appreciate, sell it years later, and keep every penny of profit. In Portugal, capital gains tax can eat 28% of your returns. On $1 million property sale, that's $280,000 staying in your pocket instead of going to Lisbon. But the tax advantages go deeper. Mauritius operates a territorial tax system. Income generated outside Mauritius isn't taxed. For location-independent professionals and investors, this creates incredible opportunities. Earn money anywhere in the world, live in paradise, and optimize your tax situation legally. The corporate tax rate sits at 15%. Compare that to Portugal's 21% standard rate. For business owners and entrepreneurs, this difference compounds dramatically over time. The savings from lower taxes alone can fund property purchases. Property ownership in Mauritius comes with fewer restrictions too. Foreigners can buy freehold property in designated areas without jumping through bureaucratic hoops. The process takes weeks, not months. Legal systems based on English common law provide familiar protections for international buyers. Up to this point, Mauritius sounds like a clear winner, and that's exactly where most investors stop asking the uncomfortable questions. There's a catch though, and it's bigger than most people realize. Location determines everything in Mauritius real estate. The island divides into distinct zones with different rules, prices, and investment potential. Choose wrong, and your dream investment becomes an expensive lesson. Choose right, and you're positioned for exceptional returns. The North Coast offers the most affordable entry point. Grand Bay and surrounding areas provide beachfront condos starting around $400,000. These aren't luxury units, but they're solid properties in established tourist zones. Rental yields average 6 to 8% annually. For comparison, similar properties in Portugal's Algarve region now cost twice as much with half the rental returns. But here's what most investors miss. The East Coast is where the real opportunities hide. Mauritius's East Coast remains relatively undeveloped compared to the tourist-heavy North and West. Property prices average 30 to 40% lower than established areas. Smart investors are buying coastal land and villas before major developments arrive. Government infrastructure projects planned for 2026 and 2027 will transform accessibility to these areas. This is where early investors win big or get stuck holding property nobody wants yet. Early investors in similar situations saw returns exceeding 200% when infrastructure connected remote areas to main population centers. The pattern repeats across emerging markets worldwide. Mauritius's east coast shows identical conditions that created millionaires in Thailand, Mexico, and the Philippines. Would you rather buy into an established market or get in before the transformation? The lifestyle component can't be ignored either. Mauritius offers year-round tropical climate without hurricane seasons that plague Caribbean alternatives. The island's political stability and developed infrastructure provide security many tropical destinations lack. French colonial architecture mixed with Indian and African influences creates unique character impossible to find elsewhere. Healthcare standards meet international expectations. Education systems follow British curricula, making family relocation smoother for English-speaking buyers. Crime rates remain low, especially in residential areas popular with expatriates, but Portugal still has compelling advantages that Mauritius can't match. European Union membership provides unparalleled access to continental markets and opportunities. Flight connections to major cities take hours, not half-day journeys. Cultural familiarity makes integration easier for many Western buyers. Established expatriate communities provide instant social networks. Portugal's infrastructure is world-class. High-speed internet, reliable utilities, and modern transportation systems support any lifestyle or business needs. Mauritius, while developing rapidly, still faces occasional service interruptions and limited high-tech infrastructure outside main population centers. The climate factor cuts both ways too. Portugal's seasonal changes appeal to many people tired of endless summer. Some buyers prefer distinct seasons over perpetual tropical weather. Personal preference plays a huge role in long-term satisfaction with any relocation decision. Here's the real twist that changes everything though. Mauritius property prices are rising fast, really fast. Prime beachfront properties appreciated 25% in 2025 alone. As more investors discover the tax advantages and lifestyle benefits, demand is outpacing supply in desirable areas. The window for affordable entry is closing rapidly. Government policies supporting foreign investment could change too. Small island nations sometimes reverse course when foreign ownership reaches levels that concern local populations. Mauritius currently welcomes international buyers, but political winds can shift quickly in any democracy. Portugal, meanwhile, might be oversold. Property prices dropped significantly after golden visa changes, creating opportunities for buyers who don't need visa benefits. Pure real estate investments might find better value in Portugal's current market than Mauritius's rapidly appreciating prices. The currency risk differs dramatically between destinations. Portugal uses the euro, providing stability and predictability for most Western investors. Mauritius uses the rupee, which can fluctuate against major currencies. Exchange rate movements can either enhance or diminish returns regardless of property appreciation. Banking and financing present another crucial difference. Portuguese banks offer mortgages to foreign buyers, though requirements tightened recently. Mauritius banks rarely provide financing to non-residents, requiring cash purchases for most international buyers. This barrier eliminates many potential investors, but also reduces competition for those with available capital. Legal systems favor different buyer types too. Portugal's bureaucratic processes can frustrate buyers seeking quick transactions, but provide thorough due diligence and buyer protections. Mauritius's streamlined approach appeals to investors comfortable with emerging market dynamics, but might concern buyers who prefer extensive regulatory oversight. The numbers reveal the real story though. A beachfront villa in Mauritius's prime areas costs between $800,000 and $1.2 million. Equivalent properties in Portugal's Algarve or Cascais region now range from $1.5 to $3 million. The price difference is staggering for comparable locations and amenities. Rental income potential swings heavily toward Mauritius too. Tourism demand remains strong year-round, supporting consistent rental rates. Portugal's seasonal tourism creates income fluctuations that affect annual returns. Short-term rental regulations also favor Mauritius, where restrictions remain minimal compared to Portugal's increasing limitations. Exit strategies matter enormously for any property investment. Mauritius's growing international profile and limited supply in prime locations support strong resale potential. Portugal's larger market provides more liquidity but also more competition when selling. Market timing becomes crucial in both locations, but for different reasons. Which option feels most realistic for your situation and timeline? The infrastructure development story in Mauritius is just beginning. Government commitments to expand the international airport, build new highways, and develop smart city projects will transform the island's investment landscape. These improvements typically drive significant property appreciation in the surrounding areas. Portugal's infrastructure is already world-class, limiting dramatic improvement-driven appreciation. Growth depends more on economic factors and tourism recovery than transformational development projects. Steady appreciation seems likely, but explosive growth is less probable. Weather and natural disaster risks present stark contrasts. Mauritius faces occasional cyclones during certain seasons, though modern building codes minimize damage risks. Portugal deals with increasing wildfire risks in certain regions, plus earthquake possibilities that many buyers overlook. Insurance costs reflect these risk profiles. Property insurance in Mauritius costs more due to cyclone coverage requirements. Portuguese insurance rates vary by region but generally cost less than tropical locations. These ongoing expenses affect total ownership costs significantly over time. The social integration experience differs dramatically too. Mauritius's multicultural society often welcomes foreign residents warmly, especially in expatriate-heavy areas. Language barriers exist, but English usage is common in business and tourism sectors. Cultural adaptation typically happens quickly for most Western relocators. Portugal's integration challenges vary by region and personal circumstances. Smaller communities might be less welcoming to foreign buyers, especially if property prices displace local residents. Language learning becomes essential for deeper community integration, though tourist areas operate comfortably in English. Both destinations offer paths to residency and eventual citizenship, but requirements and timelines differ substantially. Mauritius provides straightforward residency options for property investors meeting minimum investment thresholds. Processing times average 6 to 12 months for most applications. Portugal's residency programs became more restrictive after golden visa changes, but options still exist for substantial investors. The bureaucratic process takes longer and requires more documentation, but eventual EU citizenship provides extraordinary value for qualifying applicants. The final consideration might be the most important one. Market timing suggests different strategies for each destination. Mauritius appears early in its international investment cycle, offering ground floor opportunities with corresponding risks. Portugal seems to be resetting after a speculative peak, potentially offering value for patient investors. Your decision framework should prioritize tax implications, lifestyle preferences, investment timeline, and risk tolerance. Both destinations can generate wealth, but through different mechanisms and timeframes. The best choice depends entirely on your specific circumstances and goals. The opportunity window is definitely closing for both destinations, but at different speeds. Mauritius prices are rising rapidly as more investors discover the benefits. Portugal might offer temporary value while the market adjusts to new realities. Acting quickly in either direction seems wise given current market dynamics. Ready to dive deeper into the numbers? Check the link below for complete cost breakdowns, visa requirements, and detailed market analysis for both destinations. The Horizon Society School Group also provides ongoing updates and member experiences from both markets. Whether you choose the tropical efficiency of Mauritius or the European sophistication of Portugal, having current information and expert guidance makes the difference between profit and expensive lessons. The real risk isn't choosing Mauritius or Portugal, it's waiting until both become expensive mistakes.